Hi, welcome to this podcast where I'm going to look very quickly at bank reconciliations, but this time something that students find, two things that students find difficult in exams. One is where the question is a word question, so rather than being given a bank statement and a cash book, you then need to update and compare what's in both, but where it's given in the word as a word question form. And the other thing is working with overdrafts. So here we go. We've got a question here. I'll just give you a moment to read it. Okay, the key things on here. Okay, the cash book is showing that David is overdrawn. So that means that we need to have a credit entry in the cash book. So I've put a credit entry in there for the 31st of December 2018. That's what we thought the balance was before we did the reconciliation, and we'll then have found out about certain entries that are missing where the bank statement is the source document. Okay, and just notice on here as well, it says the bank statement at the same date was a debit of 1,398. And that also means an overdraft, because remember, what the bank statements send out is a copy of their account with their customer, which is the business, in this case, David. And from their point of view, David is an asset because he owes the bank money. So he's also overdrawn on the bank statement. Right, I've now got 4 problems on here. And what I would suggest you do is, before you do anything else on the questions, you go through the question, read through the four problems, and make sure that you're clear in your mind about whether we need to update the cash book or the bank statement for the errors. And the reason for that is, very often when I'm marking external examinations, students try and put all the errors into both the cash book and the bank reconciliation, and they don't. They only appear in one or the other. So the first one, the cash sales have been paid into the bank, but not on the bank statement. I've put that in blue. That says that the cash book's fine, it's the bank statement that's wrong. So I would write next to that bank statement, or you could write bank reconciliation. Okay, a check from a customer, Anjana, had been paid into the bank but returned as dishonoured. So for dishonoured checks, the first the business will probably know about it is when they receive the bank statement. That will be the source document, and therefore that one will not have been updated in the cash book. And that's going to need to be a credit entry in the cash book. And the reason why it's a credit entry in the cash book is because when it got paid into the bank, we would have put a debit entry in the cash book because we thought we got money in the bank, but we didn't. So it's, if you like, cancelling off when we paid money into the bank. Okay, the next one, I've done that one in red again, so that means it's going to be in the cash book. And again, I'd write alongside it cash book if I was doing an exam. And the bank has received $140 by a credit transfer from Rohan, a customer, which has been omitted from the cash book. So we know it's been omitted from the cash book. We know we need to update the cash book. We're going to debit the cash book because the money is being paid into the bank, so that increases an asset. And what I want you to notice, again, because this is quite a common error that students make, I've put the name of the other account where, in the case of Rowan, the credit entry would appear, and in the case of Anjana, where the debit entry would appear. A lot of students write standing order or dishonoured check, and that would be wrong. You've still got to say what the opposite account is on each of the entries that you make in the cash book. You can write standing order in brackets if you want, if that's going to help you, and you can write dishonoured check in brackets, but make sure it's the other account that's going to be affected with the other either debit or credit entry that you record. And then the final one, checks totaling $198 issued by David had not been presented for payment. So we know he's issued them. They haven't been presented for payment at the bank. That's called a timing difference because there is obviously a time delay between sending a check to somebody and that check being presented in the bank. And therefore, what I can now do is update the cash book. balance is off. Don't forget in an exam to put your balance CD and your balance BD in, because there's an easy mark. Even if you got all this wrong, at least you're picking up a mark. Right. I've now deliberately ignored, for doing the next bit, which is about reconciliation, the ones that I'd done in red on the previous slide, because I know now, and you could have put a line through those in your exam, I know the cash book's been updated, and therefore they don't appear in the bank reconciliation. Right, I'm going to do firstly, I'm going to show you the bank reconciliation starting as per the bank statement. And what I've put there, I've put 1,398 in brackets. And that tells me it's a negative number. And again, it's important that you do that. And when you're doing work with that number, you put a negative number into your calculator, because otherwise you're not going to get the answer right. Now, the first thing that we're going to do if we start with the bank statement is less the unpresented checks. And that's logical if you think about it, because that's money that that's checks that we've sent to somebody that haven't yet been cashed or paid, presented at the bank, so that money can be transferred out of the business bank account and into the supplier's account. So we need to subtract the unpresented checks, and the unpresented checks are 198. Okay, I could have just put that 198 here in the right hand side. I've done it this way so that if you had 3 or 4, you could list all 3 or 4 and then put a total in the right hand side. That might make your maths easier. And then I've done minus 1,398 less the unpresented checks for 198. So we now come to a minus figure of 1,596 is what at the moment we think the bank statement should show. Okay, and then we need to, I've made an error there, add the amounts not yet credited. So the reason why we add the amounts not yet credited, amounts credited on the bank statement is money going into the bank. So anything that we think should have gone into the bank, but because of timing differences hasn't yet appeared, would go as an additional to the amount of money in the bank, because we will be increasing how much money we can go and get out of the bank when we pay some money in. And here we only have one again, which are the sales that were paid in, cash sales were paid in on the 31st of December. And that's quite common because the bank receives the money and then it has to go through their system before it actually gets credited in the bank. And that normally only takes a maximum of 24 hours. With computers, that's a lot quicker now. Okay, so we've got to add that on. And what we can now see is that the balance as per the updated cash book is 1,234. The balance per the bank statement is 1,398 as an overdraft, and therefore the bank statement and the cash book have been reconciled. Now, unfortunately, in an exam, you sometimes do have to start with the balance as per the cash book. Occasionally, what they do is they will give you a question where they don't tell you how much the overdraft was. If we're doing a balance as per the cash book, what we do, we just reverse these lesses and pluses that we've done starting off with the bank statement. So we need to add the unpresented check, and we need to less the amounts not yet credited. Okay, but obviously if we're just changing the order around, it's still going to give the same balancing figure. Right, very quickly, what do we do? Why do we do a bank reconciliation? There are a number of important reasons. It checks that differences are timing differences. So what we mean by that is due to either a delay in us receiving the bank statement, and so being able to update for things like standing orders, or it's a delay between us sending a check, for example, and the supplier presenting that at the bank for payment. It ensures that at least once a month we're able to update the cash book and make sure it's right by using the bank statements as source document. It's a check for errors on both the bank statement and the cash book. Here, bank statement or the bank reconciliation reconciles. If this figure, for example, at the bottom, the figure for the balance as per the bank statement was different to the actual figure in the bank statement, then we know we've got an error either in our own cash book or the error has been made by the bank. It's a deterrent for fraud because the bank statement is produced independently of the bank statement, and normally somebody different to the cashier who actually puts the entries into the cash book will do the bank reconciliation. So if there is a difference, we know it's either an error or a fraud, and therefore that deters the cashier from putting fraudulent entries in. Probably a slightly less important one, but it does help the business to identify checks that's paid out that are more than 6 months old and still haven't been presented at the bank, because the bank won't accept those checks. And it shows the business the actual amount of cash it has available at any time. You can't trust either the cash book or the bank statement to be 100% correct at a particular moment in time. And therefore, if the business needs to know, I do have $1,100, I do have $2,000 in the bank, the only way to check is to do a reconciliation. Okay, I've put some questions